My worst return ever was a 2x multiple of invested capital. My best payday ever is 11 times multiple of invested capital. That's why arbitrage is so powerful. Why should all them fat cats in New York and them private equity guys make all the money? We can teach you how to do this yourself.
Can you make nine figure doing this? And I just cut off Adam as he's about to tell us what we were going to do. On the last episode, we talked about, can we buy and sell companies together? Or can you take your company, put a bunch of companies together with no money? And it's not about no money down gimmicks. We talked about various creative ways. And Adam actually literally broke down with spreadsheets, real data, 2.46 billion in exits, 50K company acquisitions, nine-figure entrepreneur to over 70 companies and brands all over the world. We are partners. We do it just me and him. We do it together with people here, or we show you how to do it. Either way, we want to do it with you as well. But you must like, comment, and subscribe. Make sure so that you get more updates. And please go back to the previous episodes because every single one of them are different on its own. And if you want to do this together, go to adamcoffey.com, EY as well. And of course, one of the greatest books of all time, Empire Builder, although Adam has 3 best-selling topics, it's only the best one because...
Fourth one coming out in a couple weeks.
Oh, you went like this, huh? You went a little the douche thing.
Yeah,
here.
so and I went t-shirt. I went casual. So I went Armani t-shirt.
You know what?
Yeah.
This you know what I mean? So
yeah, that is a classic. I really do want a high resolution
I'm going to get you that
image so that
I'm actually going to re-engineering
office.
the book. You know, before we go, re-engineering the book because I read this and I'm like, this made me to 10 million. But these skills it's not the 100 million plus, but it's the solid fundamentals as well. And books are probably the longest things you can do with the worst, least ROI possible. There's so much better things we can do. So Adam, we've been talking through this and I feel, so listen, let me ask this. Real estate has created a lot of multimillionaires, but the billionaires and a lot of nine figures have been created in private equity. Let's be honest. When's the last time we saw someone in Forbes magazine, the richest list, did it in real estate? If they did, they started 50, 60 years ago. They bought land like, you know, the Irvine Company, and they've had it in California, didn't do anything. And now they're selling it for this. I mean, the odds of becoming a billionaire. And in some cases in real estate, to be a nine figures, you have to spend a lot of money. You know, I'm in my first $10 million by the age of 28 in real estate. Now, obviously over 70 companies and brands and all over. And now I'm doing this with you as well. And to me, I realized that, you know, I just can't make nine figures in real estate anymore. And I can diversify and it's a safe investment. But I was like, okay, how do I make nine figures doing something? And ultimately led me to the billionaire. And this was the idea of buy and sell companies because that's what these private equities do. And that's where I found your book, interviewed you on my show, which I probably should release it. And then you and I can maybe watch it together, like a play-by-play, because this was during COVID. And so explain why are the returns on a private equity on the buy and selling business is higher. Now we see the numbers of being like, hey, this is a good number, made a lot of money, but how many of them don't make money, realistically speaking, right? And so,
yeah, you know, I've been running companies for private equity for decades. I've been investing in companies with private equity for decades. My worst return ever was a 2x multiple of invested capital, which means for every $1 I invested, I got $2 back. That's higher than the S&P 500. My best payday ever is 11 times multiple of invested capital. And my career average is about 5 times multiple of invested capital. So private equity, you know, in their world, private equity investors, you know, they're able to generate returns that are outsized of the market. And typically they would beat the pants off of real estate investing as well. In real estate, you know, you need a lot of capital and a lot of debt. And then you're acquiring a property, you're holding it, you're trying to get it to cash flow enough to cover expenses. And then you're going for the appreciation of one property over time. And this is the key differential. And so what private equity is doing that is different. Now, first of all, I'll just say up front, to sell a good company at a good multiple and make a lot of money, it has to be a good company. I can't just buy a bunch of crap, put it together. It has to be a company that's an integrated platform that is taking advantage of the synergies of putting multiple companies together. It's growing strong organically. It's improving its margins as it's getting bigger. But if we're doing those things, the largest segment of profit in private equity is created by the arbitrage. And so I know we've done this before, but if you don't mind, I got to visit back to my PE pyramid. And so just real quick, there is $6 trillion in capital inside this pyramid. There are 8,000 private equity firms on this side of the pyramid, and they're aggregated by size. So at the top, I've got KKR, Apollo, Carlyle, Blackstone. I've got all the big firms that have got funds that range between 10 and 30 billion in size, all the way down to really small PE firms that are investing with funds, that are less than 100 million, in size in their fund. And so all of these guys do the same things. They all invest 6 to 8% of their fund in one company, and they don't invest more than 12% in one company. And as a result of that activity, and they all have a fund that lasts for 10 years, and they all have to buy companies within the first 5 to 6 years, improve them, and sell them and return all the capital by the end of the 10th year. So I've got this short window, average hold period's 5 years. Because big funds that want to deploy 6 to 8% of their capital in one company, that's a big check. If I got a 10 to $30 billion fund, they can't buy small companies. It would take them 100 years to put their money to work, and they only have 5 to 6 years to do it. So the net result is there are 5 swim lanes of capital. Big firms with big funds buy big companies, small funds, small firms, small funds buy small companies. And the pyramid steps vertically are how big I can build a company in a 5-year period between the size I buy them and the size I sell them. And remember, since I invest 6 to 8% of my fund in one company and no more than 12, I have a certain size, depending on my fund size, where I'm entering the market. And then the average 5-year clock starts ticking. That's my average hold period. And so there's only so far I can go in my 5-year period. And that kind of sets up the top of the swim lane where I'm going to then sell companies. And that's where the buyers are circling. So in the US, 34 million small companies. There's so many of them. We were just looking at bookkeeping, 1.8 million bookkeeping and accounting firms in the US. Tons of them down here. Matter of fact, 99.9% of all companies in the US fall in these 2 categories right here, the smallest companies. And there's too many of them. There's not enough buyers buying them. And so the multiples paid are small. When I get up to the top, there's only 3,000 companies on the planet that have $1 billion in revenue. And so as we get bigger, we get rare. This is a Velcro patch. I take it off the wall. I throw it in my shoebox. I bring up the one for accounting, bookkeeping, payroll, and I slap it up here. And what I'll see is the same impact, not the same numbers, but the same impact. Tech companies would have higher multiple numbers, and boring bookkeeping accounting companies, would have lower numbers. But this is a pretty good one to illustrate. So my last empire, I bought 5 small businesses, and this is earnings, by the way. So I bought 5 small businesses that all had about $2 million in EBITDA. I paid on average 5 times for them. I paid about 10 million. I buy 23 of them and I add them together and I climb the PE pyramid. And then I sell it for 14 times. And so here's the difference between real estate and business, JT. It's a nuance. But when I invest in a piece of property, I'm only investing in one property. And the appreciation is just of that property. I may buy multiple properties, but the profit's only being made off of one. The concept here is different because I buy 23 small companies that are too small and there's not enough buyers. And so I pay a cheap price. But when I get bigger, all of a sudden I've gotten above that 34 million pack and I'm now a bigger company. I'm in this swim lane. And these bigger funds don't have as much opportunity to put their money to work. And so there's a feeding frenzy for a big company that rises out of the pack and hits this level. And I'm rewarded now with 14 times multiple. So for every $1 of profit that I bought and paid $5 for, I'm now selling the same $1 of profit for 14. And that's a $9 profit per dollar. So I buy 23 companies. That's 46 million of EBITDA. I buy them for 5 times on average. It costs me 230 million. 46 times 5 is 230 million. When I sell the same companies now integrated plus organic growth plus margin improvement, and I sell it for 14 times, that's 644 million. minus the 230 that I borrowed to buy the 23 companies, because that was 100% debt. And then I put $414 million in profit in my shareholders' pockets. This is just the arbitrage component. And so now if I'm doing this, I don't have one building. I've got the arbitrage of 23 combined in one investment vehicle that now gets sold at a higher multiple. And the end result is I create massive amounts of wealth. And so that's why arbitrage, is so powerful. I don't need to buy bad companies, and fix them. The money is created naturally by me getting bigger and putting them together. And so I want to buy good companies run by good people. And if I
All right,
do that,
we'll make some deals happen. Let's get to that. We have 7 minutes to go over. What are the skills needed to do this as well? Meaning that this is the skills you are, and if you have weakness in this, so let's go one by one. So what is the most important skill in order to do this?
so I need to know what good looks like,
So
and
you have to be good at evaluating deals,
yes,
which
and let me just say, JT, if I don't have these skills, I can learn them, but I still have a learning curve. So better to build a support system around me to get help. Get help from people who know what good looks like in an industry. I get hired all the time to do that for certain industries. And so I could build that skill. I can read books. I can surround myself with coaches and mentors who know how to do this stuff. But I need to understand what good looks like. I need to know the fundamentals. Last episode we talked about, I need the fragmentation, the needs versus wants, the recurrent revenue. If I don't know any of this, I might think, hey, I'm going to do a buy and build in restaurants. Well, that's a tough ass business. And, and while you could make money, the odds are probably stacked against you. It's going to be a harder slog. So it's like, I need to know, well, the difference between a good industry, a bad industry, good profile of a company, bad profile of a company. So I need some skill in understanding what a good business looks like, what the financial fundamentals look like. If I don't have that, I could partner with someone who does. Maybe I've got a good friend who's a CFO. They're not going to do any of this buy and build stuff, but I could cut them in for a piece of my action, and they could help me evaluate the income statements and balance sheets of the companies I'm going to look at. So a lot of different ways we could get that.
and also too, if you don't have the skills to know how to evaluate, no different than real estate, you're going to get burned. You're going to make the wrong decisions.
Yep.
So one is evaluate. What would be a second skill that's important?
So I need to do research on an industry. I want to put together my thesis, my model. So last episode, I showed a model. It's like, I need to understand what these companies are selling for. I need to understand what fair market value is. I need to build an economic model, because if I don't have a destination in mind, I can't get there. I don't know if I'm on track, and so once I know where I'm going, I'm starting at 0. I want to go to 20 million, in profit, like that last model. I can now reverse engineer how many companies do I have to buy at an average size that keeps the purchase price low. I assemble these. So I have to be able to put together some kind of a financial model. I need to then also now start thinking about, how am I going to pay for all this, and how am I going to use, get lending for the debt that I do need. And if I need a small equity component, where is that going to come from? So I need to know, I need to understand what good looks like in a given industry. I need to be able to do some basic financial modeling in order to know, kind of what the dynamic is. It going to work? If it doesn't work on paper, it's not going to work in life. And then I need to start thinking about debt, capital stack, and I could go on and just say, hey, I need to be a good read of personality in people. I need to understand. So like my last company, I bought 23 companies. Can you imagine 23 entrepreneurs who've never had a boss before, who all just became rich because I gave them a bunch of money when I bought their company? And now I got to get them all to sing Kumbaya and move in the direction that I want them to go. I used to tell people I'm a den mother, man. That's one of my big skills, is I can get people aligned, and so being able to articulate a vision, create a story that those founders are going to buy into, that you're a person that they can join, give up control of their business because they're going to make money. It's like, you have to have some gift of personality skill yourself. And if you don't have that, not saying you can't do it, it's just a little bit tougher. So a lot of these skills, JT, they aren't what
everything can be learned.
Yeah.
But the naive is that I'm going to have no skills, no money to do anything. That's wishful thinking. And
the
again,
other naive thing, JT, is thinking I'm going to have no risk. that no matter what the hell happens,
Yeah.
I'm going to walk away scot-free if it doesn't work. No risk, no reward.
And also I think when you're taking out seller financing, I think there's a fiduciary obligation. This person trusted you to do what you say you're going to do, and they're in a secondary position. I've always said, treat other people's money more conservative than your own. And I think a lot of people think about, well, I'm putting no money down, so there's no risk. And I made a mistake in the real estate space in the last year and a half, investing in people who had no money, and say, hey, listen, I'll fund all your deals. We'll split 50-50. And interestingly enough, I did 6 of them. 5 of the 6 lost money. I never lost money. I'd done over 1,000 deals. And 4 of the 5 quit. And you know what their thing is? Well, I'm not making any money, so what's the point? I'm like, but it's your deal. And because there's 2 things that I think are utmost important. And you and I talked about this, is if you have money to lose and you have reputation to lose, you're more likely to be more invested, because reputation is actually more important than money. Because once your reputation is gone, the money's irrelevant. It's not going to come as well. So I've learned a lot of valuable, and I've also learned that when I partner with people like Adam, who have same net worth as me, similar net worth as me, then you know what? We both have to lose. And we're thinking about, hey, our reputation, our credibility. Hey, if it doesn't work out for the people, like what we're going to do. No, you and I had raised, we wanted 5 million, 11 million people came in, and we said, hold on one sec, let's just use our money, do this as well. And then we decided to pull back because we had a partner that was not in line with us. You know what I mean? Like everybody wants to be, the owner of the restaurant, but not go into the restaurant. You need someone to go in, you need someone to cook, you need to put the deals together. And on our next episode, what we're going to talk about more skills that are needed. But also we're going to talk about, if you have an existing company, you have a company, and then what do you do to merge and scale? So we didn't talk about putting all these companies together, which you can do with, or whether it's your company or not, but specifically you have a company, when's the right time to do that? And in future episodes, we're going to evaluate other transactions they did and how they got to 9 figures, right? What did they do? What was the acquisitions? What were their numbers, which the research can be done? If you want to learn, or you want to do it with us, with your company, or you know somebody, there's a link in the comment, adamcoffey.com. Also and subscribe to this channel so that you get notification when the next episode is there. And please go back to the past episodes. You're going to learn tremendously. And do us a favor, share it. The more you share it, the more engaged, the more likely we do it. Adam, you've got the final line before I go on having my 14 million phone calls today.
You can do this. It is not, a mysterious thing that only a multi-billion-dollar private equity firm can do. You actually can learn how to do this. That's why I dedicated the next 10 years of my career to working with JT, so that we could help a broader audience, and make this kind of wealth happen for smaller investors and smaller, call it smaller business owners. Why should all them fat cats in New York and them private equity guys make all the money? We can teach you how to do this yourself. Peace.
And on another show, we're going to say how to set up your own private equity. I'll get my own attorneys to come on there as well, talk about this. So we're going to talk about a lot. We're going to disrupt everything. So please make sure that you keep listening. Thank you so much. We will see you on the next episode of Can You Make 9-Figure Doing This? And you can. But like anything in life, nothing is easy. We'll see you on the next one.